In today's video, I'll be going over how we can flip $500 to $5,000 right over here. Now, this video is to show you guys a perfect risk management, and we'll be using correct risk management as seen over here. Now, before I go over the risk management strategy which I'll be showing you guys, which is extremely powerful, I want to show you what exactly not to do. So if you have a $500 account, for example, I've seen a lot of people try and risk 100% of the account balance and to try to flip it and to make £1,000 from that altogether. So then they're going to go from £500 to £1,000, flipping it 100%, and then after that they'll be like, you know what, since the account balance is getting a bit bigger, let's start risking 50% of the account balance to then make $1,500, and they'll continue risking large sums as such to try and flip $500 to $5,000. Now, the biggest issue with risking 100% of your account balance or even 50% of your account balance is it only takes either one trade or it will take you 2 trades to blow the entire account. Now, the goal of this risk management strategy is to flip $500 to $5,000 with some longevity. Now, of course, it is a flip challenge, so you don't want to be taking forever, and you don't want to be taking years using 1% risk, for example, and risking 1% of your account balance to then reach that $5,000 goal, because that would take absolutely ages. So then now some of you might start saying, all right, so to have some longevity in the markets, if we have a $500 account, let's just risk 10%, which is not that big, nor is it that small, and keep to that consistent 10% risk all the way until we get to that end goal of $5,000, for example. Now, yes, you can do that, but then again, if you're risking 10% of this account balance, it will only take you 10 trades to blow that entire account, because risking $50, all it will take is 10 trades, and then you've lost an entire $500. So again, it is a bit risky, and the risk management strategy which I'll be showing you guys now is the best strategy to be using when you're flipping accounts. So this risk management is the compounding risk management strategy. So what does that mean? What the rule states of this strategy is, if you want to flip something small like $500, you want to start off with a decent enough risk. So let's use 10% in this case. If we're using 10% risk, now, like I said, with the previous strategy of keeping a fixed 10% risk, it only takes 10 trades before you lose your account. However, with the compounding strategy, if you're risking 10% of $500 and you lose the first trade, you're left with $450. Now, in this case, you're going to be risking 10% of the trade of the account balance, which is $450. So the next trade, if you're going to be risking, you're going to be risking $45 for that trade. Now, by doing this, it will take you way more trades to blow your entire account. So to give you an example, if you then lose another trade, your balance has now gone to $405. Now then you risk 10% of that again. Now your balance is gone down to $364.05. Where in comparison to the other strategy which we was using, if we used this side over here, if you're risking $500 and it's a fixed risk of $50, you've gone from $500 right over here to $450. So it's the same right now, but then in this case right over here, instead of your account balance being $405, it will be an account balance of $400. So you're saving $5 extra by using this compounding strategy. And as we go down lower and we go to the last trade, the 10th trade over here would be, let's say it will be $50 left in your account on the 9th trade, and then one more trade will blow your entire account. But if we use the calculator over here and we was to go down to the 10th trade in this over here, that'll be 9, 8th trade, 7, then 6, 5, 4, 3, 2, 1. So your account balance here will be $193. I hope this is making sense to you guys. The point what I'm trying to show you is, in 10 trades, if you're risking a fixed amount of 10%, you will blow your entire account. But in 10 trades using the compounding method, you will still have $193 left in your account, which means you have more trades that you will need to lose in a row to blow your account in comparison to keeping a fixed risk. Now that's covering your downside. If we now take examples of how to flip this account from $500 to $5,000. So if we have our starting balance right over here of $500, and then the next trade we are taking, we're risking 10% of this account balance right over here. That will be $550 that you made on your first trade. Now if you continue doing that, the next trade will be 10% of this account balance. Now 10% of 550, so now you're going to be at $605. Now if you continue doing this and you have a target of, let's say you want to be making 5R per month on your trade account, risking 10% of whatever the account balance is, that's going to be giving you from $500. Then after 1 month, your balance is going to be at $750, provided that you're hitting 5R every month. And then next month after that, if you have a gain of 5R again on this account balance, your account balance is now going to go up to $1,125, as opposed to if you just risk a fixed 5R of $50, all that's going to happen is you're going to go from $500 to again $750, and then from there your account balance is going to be $1,000, because you're just risking 10% of the original balance. So you're just risking $50 and you're making 5R, which is equal to $250 per month. So all this is saying is that you're taking the same amount of trade, but since you're risking 10% of whatever the balance is at the end of the month, you're going to be increasing your profits ever so slightly, and by the time you get to the further month, it's going to start to compound. So if we continue this example right over here and we bring it down to this part over here, you can see that $1,125, if you make a 5R return on that, is going to go to $1,687.5, and if we continue this on, it's going to go to 2.5k. Then the next month is going to be 3.8k, and then the last month is going to be 5.6k. So you flipped your account in, so that's 1, 2, 3, 4, 5. In 5.5 months, you've basically flipped your account from $500 to 5.6k. So by doing that, you've now flipped your account using correct risk management. So in other words, by using the compounding risk management strategy, you've gone from $500 to around $5,695.31 in a matter of 6 months. So it will take 6 months to go from $500 to $5,000, but this will allow you to have correct risk management, because even if you're risking 10%, it doesn't actually take you 10 trades in a row to blow your account. It's way more than that, because you're risking 10% of whatever the account balance is. So your risk is reducing as you're taking losses, and then your risk is increasing as you're taking wins. So it's a compounding risk management strategy, which if any of you did not know, you should definitely try this out in your own trading, because it will help exponentially grow your account. And you'll see, if this is the chart, you'll see gains going exponentially up like such, as opposed to risking a fixed amount. So if we use another graph, if you're just risking a fixed amount of 10% or 1%, like some of you guys may be doing to keep conservative, you just see some sort of linear curve to the upside, because it's just a fixed amount increasing every month, as opposed to more sort of a exponential curve. So by that time, near the end of your journey, you will see exponential growth coming through. However, the same is also equivalent. If you're using a linear risk management, you will also be losing a lot more in comparison to an exponential, which will cover your downside. So in trading, it's always important to be covering your capital. So an exponential risk management strategy where it's compounding would reduce your losses as you go into the minuses, as opposed to a linear one where you blow your account soon enough if you're risking a large amount. So before I wrap up, just to give you guys some sort of stats so you guys don't need to work out yourself, if you're risking 10% using the compounding risk management strategy, it will take you 22 trades in a row to lose before you blow your account, before your balance ends up to a very small amount such as $50. So if you're starting off with $500, it will take 22 trades in a row to end up with $50 in your bank account, in your trading account, by taking 22 losses in a row. If you feel like that's a huge amount and you're willing to risk a bit more, because then you will see that exponential curve we was talking about increase a lot earlier, then that would take near enough 10 trades before your account reaches $50 from $500. So it's always important to think about the drawdown more than you think about the gains, because minimizing your drawdown is way more important, so you have more longevity in the game. So if you feel like your trading strategy will not take more than 10 losses in a row, be my guest and risk 20% of your trading balance and use that compounding risk management we was talking about. If you feel like you need a bit more of a breathing room, then risk 10% of your account and you'll be able to reach $5,000 within 6 months. And if you risk 20%, then therefore it will be 3 months to flip your account from $500 to $5,000. Now I hope that I did not confuse you guys, and I hope this did make sense to you. Be sure to run the maths on it yourself and leave a comment in the section in the comment section down below if you already knew about this compounding exponential gains model, or if this is something new to you and you're going to definitely look into it. So I hope you guys did enjoy this video. If you did, be sure to like, drop a comment for any further video ideas you have, and I'll see you guys next time.